Thank you, everyone, for joining us today for the fourth quarter Feldmeyer Forecast. I am Derek Miller, and with me, Ben Feldmeyer, our host. So, as we jump in to review the topics we will cover today, we want to start with where are we? So, what's the current state of the economy? And then something that's been on every consumer's mind is inflation. How are we doing? And is it getting under control? What affects that is our consumer and spending, as well as where are we going with the AI and the tech boom. We'll take a look at a couple of the top 10 stocks in the S&P 500 and answer the question of whether or not we think it's a bubble. And then ultimately, what do we see the Fed doing with the interest rates and the effect on short-term investments? And then again, we can't forget that it's an election year. So as we start off with the economic growth, and where are we now? If we go back to where we were in 2001 and look at the trend line, the growth that we had prior to COVID, we were averaging about 2.1% growth on our economy. And then we see here in 2020, we had the large dip. And then ultimately, we had a recovery, and we are actually stronger today than we were pre-COVID if we just continued on to the same trajectory. So even though it's an election year, you might hear things about how the economy is doing, whether it's good or bad, depending on which party you listen to. When we look at the data that we've looked at for over 20 years, our economy is growing and we are strong. A big piece of that is the consumer. And let's look at some of the things that affects the consumer, such as inflation.
Well, the big thing that's being talked about is inflation, and what we see on our graph here is an explosion of the cost of living. Let's take a quick glance at the orange section right there in the middle of the chart. That's our core goods, and we see how expensive they were growing at such rapid value so quickly. But then if we look at the bottom right-hand corner over there, we see that those prices are actually coming back down. As a matter of fact, we're even seeing signs inside retailers that are saying our prices are coming back down. We're seeing them all over the place. The one that we keep pointing out each quarter, though, is that dark red, the auto insurance. This is not going to be getting smaller. As we've shared before, the cost of replacing vehicles because of the amount of technology that's involved with them continues to rise, and they're totaling out more cars simply because it can't be fixed. If the airbags deploy, for example, they can't put those back together, right? You can't put Humpty Dumpty back together again. So they're having to just replace a lot more cars rather than fix them, and that's driving up the cost of auto insurance. But overall, we're seeing the trend moving in the right direction, including energy prices being under control and core goods actually prices coming down.
Yeah, so that affects the overall inflation rate because we keep hearing, but inflation's shrinking, but the prices are still high. Remember, inflation is just how much more expensive it is today versus a year ago. So we don't see prices going back down to where they were pre-COVID, but we might see some areas such as core goods actually try to reduce their prices to try to entice consumers to spend their money. One of the ways that we see this is if we look at the consumer spending and savings. Again, this is a graph that goes all the way back to the 1960s. We see the average savings for an American household is about 8.5%. In 2020 and 2021, that skyrocketed. We had extra stimulus money coming in. We had to stay home, so there's less money less things we could spend money on. And then there was also the piece of it that people were just scared and weren't sure, am I going to be okay? Am I going to have a job? Once some of the lockdown easements happened, we started to see consumers go back out and start spending money, which means they were saving less. Now cash is at an all-time high, and we have consumers starting to save more and more. What are the big retailers doing besides just lowering the everyday prices to try to get consumers to spend money? We are seeing Amazon Prime being the largest retailer online. We see them have their Amazon Prime Day deals. They used to do this once a year, and now they do it in October. They do it in July. They do it Cyber Monday for Black Friday sales. So we're seeing a lot of that. And every time that Amazon does this, other retails jump on. So Walmart never wants to be left behind. Target actually does it even longer than Amazon. They do 2 days. Target did an entire week. Wayfair had it up to 60% off. We're in October and we're already having holiday sales. So these companies are seeing the consumer being strong, trying to entice them to save or spend some of their savings.
The consumer is increasing the amount they're saving, but the tech companies are not. What we see on the left-hand side here is CapEx, that's capital expenditures from all of your major tech companies. So we see there in billions of dollars how much Alphabet, Amazon, Meta, Microsoft, and Oracle are spending. The left-hand side of the axis indicates in billions of dollars, and the right-hand side of the axis indicates percentage of their operating cash flow. So we are forecast here for 2024 to be around 192 billion, which is approaching 80% of their free cash flow. Forecast for next year, closer to 90%. Forecast for 2026, we're closing in on these companies, the forecast being that they could be spending almost 100% of their free cash flow on capital spending. Now, if we look over to the right, we see, okay, what are they spending the money on? And we see semiconductors, equipment, computer equipment, all this stuff is just upgrade, 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 upgrade. And there's no end in sight on this. So while the consumer has been saving and is now spending and is going back to saving, we see that the tech companies are foot on the gas all the way down to the floor. Spend it, grow.
And it is the largest 10 companies for the most part that is dumping the most amount of money in there because they're trying to take advantage of what they see being a very large opportunity in the market. So we've seen this a lot with the S&P 500. I know we've covered this on past forecasts about be careful about indexes and the values that they bring in. Last year it was the Magnificent Seven. If we look at the top 10 here, how much of the S&P 500 is controlled by the largest 10 companies? And we could see as of the end of September of 2024, it was close to 37%. And it's actually started to come down slightly, not because the top 10 companies have lost any of their value, but it's the other 490 have started to participate in this up market as well. So it's a little bit more broadening of valuations, which is good. If you look at the bottom chart here on the bottom right, you see of the top 10 companies, how much of the S&P 500 spending is controlled by the top 10. So for R&D expenses, the top 10 control 41% of all research and development. The top 10 also control 26% of the S&P 500 free cash flow. So 10 companies out of 500 control 26%, over a quarter of the free cash flow, which is just pretty outstanding when you think of that.
Unbelievable how profitable they are.
Yeah. So they're going to continue to reinvest in their companies to try to make themselves even more profitable, which makes us think this AI hype probably has some legs in it still.
A long ways to go, for sure.
Still some opportunity. Valuations, according to historic averages, a little bit higher than normal, but not anything where we're concerned of potential bubble.
Shifting over to a little bit of a boring topic here, looking at the yield curve, we know that the Federal Reserve has been cutting interest rates. And what that means is that if you go to the top left-hand corner of this chart, we see that very short-term interest rates are getting the very highest yield at this, shortest term maturity are getting the highest yield at this stage of the game. This is the stuff that the Federal Reserve can reduce. And they're reducing this, and these numbers are going to start to fall. Now, they're not going to fall overnight, but if you look back on things a year from now, a year and a half from now, these charts aren't going to look like this. They're going to look more like the chart down at the bottom, which is more of a standard type yield curve that we would expect, low on the bottom left and higher on the right, because the further you go out on time, the higher the interest rates you get. Our point on sharing this is that if people are sitting in a whole lot of money of cash and saying, this is my investment strategy, this is going to come back to haunt them because that money is a money market account is a place to hold funds for a short period of time. And if you're doing that, that's fine. Let's just be sure we're not holding it there as the investment strategy, because if we want something conservative that's going to pay a nice rate of return, the bond market is giving us a much better option on things. Our bond portfolio, as of the time that I'm recording this message, the yield is at 6.3% with a duration of 5. What that means is that if interest rates fall by 1%, the value of those bonds are going to go up in value by 5%. And the forecast is that interest rates are going to be coming down. So as opposed to riding the curve down and continuously getting less and less and less rate of return, it would make sense to deploy the capital into something that has a better opportunity for us and makes more sense longer term.
So now when it comes to the election and how that impacts different sectors of the S&P 500, this is just one small example. We could do this for pretty much any industry, but mainly don't let any political headlines or biases impact where you want to invest your money.
Don't listen to the guy in the cubicle next to you at work. Don't listen to your neighbor over the fence. Don't listen to the news on TV. Don't listen to the commercials. Don't listen to any of this stuff.
So if you were to listen to any of the election debates, you would hear that, Donald Trump wants to drill, baby drill, and produce more oil than ever before. And, climate change isn't a thing. We're not worried about clean energy and windmills. But if you look at the clean
and the flip side, that the Biden administration doesn't want oil and only wants clean energy, right?
Correct.
It's being painted.
Correct. So if you were to just listen to political headlines, that's what you would hear. But if you would look at what's actually happening in the economy and what's happening in the investments, the iShares Clean Energy ETF went up by over 300% during the Trump administration, outpacing the S&P 500, or just the regular energy sector, which lost 30%. So I could either be down 30.
It's the exact opposite of what it is that one would think.
Or over 300% if I was only focused on clean energy. And then for Biden,
it was the opposite.
Yeah.
Right. So the energy sector has surged 148%. We're pumping more oil than we ever have. Okay. And this is supposed to be the green energy group, right? So be careful of bias on things based upon political rhetoric, because it doesn't always pan out to actually be accurate.
Yeah. Which will bring us to our key takeaways, which is regardless of what happens in the election, the U.S. economy, the consumer, the companies are going to continue to thrive, and growth rates are going to continue to, we don't see it slowing down. So we're past the pre-COVID levels. We continue to see that being a thing. A big driver of that is inflation is down and jobless claims are, depending on which month you see, which report you see, they're ticking up a little bit, but it's very reasonable. It's actually what the Fed wants to see. It's giving them the ability to cut rates, and we expect them to continue to do so, but cautiously, just like they've been cautious this whole 2-year period.
It's all data dependent.
Yeah.
So we expect the Fed to continue to cut interest rates very slowly. The consensus at this stage of the game is probably 25 basis points in November and 25 in December, and then 4 rate cuts, probably at 25 basis points apiece over the course of next year. But it's all data dependent, right? It's a we'll see. So the money markets have been a great place to keep cash, but be aware that the longer you wait there, the interest rates are going to start coming down on things. And let's be real careful of political headlines or bias affecting our long-term investment decisions. The last couple of weeks, I have found myself catching 60 Minutes on Sunday night. As of today, last night's report, they interviewed the person who's in charge of all voting in the state of Pennsylvania. And he explained that the state of Pennsylvania's law says they are not allowed to even open any mail in ballots until Election Day. And they have hundreds of thousands of them that they've already received, and they are all opened by hand. And he explained that this is why it's going to be delayed. It just is. So I share that because we need to be prepared for the fact that we're probably not going to know who won the election the next morning. It could be a couple of days, and that this is a known scenario, and that we just need to plan on the fact that each state needs to follow their own process, and we'll know who the winner is. But it could lead to the market bouncing around a little bit here while we're waiting, and it will certainly lead to a lot of political rhetoric across the board. So just be aware.
I think that wraps up this quarter's Feldmeyer forecast. We thank you guys for tuning in and really appreciate you for joining us here. And we look forward to touching base with you and see you at the next one.
Thanks.